Hello and welcome once again to the FX Week Ahead with HYCM webinar. My name is Giles Coughlin and I'm a currency analyst with ForexLive.com, and I'm going to be looking ahead at what opportunities and things there are to learn from the week ahead and how we can best trade the markets. If you just want to ask a question during our time, don't forget there is a question box. And I know a number of you used the questions last time, and that was quite helpful for me to know where you guys are at, and hopefully I was able to direct some of you into the right kind of direction. So that was, thanks for using the questions. I'm just going to see who's here, who's coming. Okay, hi Fernando, hi Gabrielle, Mo, Saud, Tian, Askar, thanks for joining. Good to see you. We're going to be getting on ahead now and working into the webinar. Now, what we've been doing recently, because the markets are very interesting at the moment, because some of the biggest drivers in the FX markets at the moment are geopolitical concerns. And that's been true for a number of weeks, and it's still true this week. So we're going to go through some of the big geopolitical issues that are just on the sidelines and are constantly kind of in the background and influencing price and price movement as traders are trying to price in certain risk events. Now, one that we've covered before, well, we've covered all of these before, they're sort of ongoing, but the situation with the Turkish lira. Now, what I highlighted to you guys last Monday was there was a press release out of the Turkish Central Bank. And what they said was this. I put it on the screen for our convenience. And this is from the Turkish Central Bank website. It said recent developments regarding the inflation outlook indicates of significant risks to price stability. Obviously, the central bank has been struggling to keep the Turkish lira from depreciating. It's quite well known how much the Turkish lira has depreciated, and Turkey has a real problem. They run their economy on a current account deficit, so that just means they have to borrow money in order to keep the economy running. So the weak lira has really affected them, as the US dollar has really appreciated heavily against the lira. Now, the Prime Minister Erdogan had quite a maverick policy, and that maverick policy was that he didn't want to hike interest rates, which was the typical way that he could have controlled the heavy fall in the Turkish lira. So his son-in-law was leading the central bank, and now his son-in-law has left, and the central bank is getting a new approach. And this was the press release on the 3rd of September 2018. It says the central bank will take the necessary action to support price stability, including. Oh no, hang on, I just don't see this. Sorry about this. You can't see the screen. There we go. Sorry about that, everyone. I hope you can see the screen now. So there we. Yeah, okay. Sorry, Mo. Sorry, Ham. Have you got the screen now? Is that all okay for you guys? Just want to quickly send me a message. I think it should be. Sorry, fellas, I forgot to press the right button. It is visible. Okay, Saud, Ham. Yeah, sorry about that, folks. Okay, so this was the press release that I was talking about. Don't worry, you haven't missed anything at all. Thank you for letting me know. The press release is here, which you can see now. And the key aspect of it is that the press release is saying that the Turkish Central Bank is now going to be increasing interest rates. See, they're going to take the necessary action to support price stability. Now, when this released, it's here on the 3rd of September. You see this candle on the 1 hour chart. That was the Turkish lira appreciating, which is US dollar, Turkish lira bearish. And the reason it was appreciating because the markets knew, there's an interest rate rise that's coming. Now, the market is anticipating an at least 3.25 basis point interest rate rise. So there is, first of all, say that once you saw that information come out, what you knew is that the market knew that the Turkish Central Bank was going to intervene in order to stop the continuing weakening of the Turkish lira. Now, you've got to remember, traders all around the world are seeing what the central bank is doing. Central banks want to tell the market what's happening in order to get price stability. And you saw that phrase, didn't you? in the report. Let me just show you, where is it? Where's the keynote gone? There it is. You saw that phrase. Look, to take the necessary action to support price stability. And that's what the central bank is wanting to do. So as soon as you know those interest rates are coming, this was an obvious place to place your stop, because that is the price prior to the announcement. So it's very unlikely that price was to rise above that level, because that's when the Turkish central bank said they were going to be intervening. So it's no surprise that you can see the Turkish lira has appreciated over that coming week. Yet price went back up to these highs, tested it, found sellers once, found sellers twice, and now you can see how price reacted around the moving averages. I've got the 50, the 100, and the 200 moving average. That's the 200 is in red, 100 is in blue, 50 is in yellow. And then you saw, look, there were actually 3 opportunities to short the US dollar Turkish lira currency pair last week. It would have been once up here, once there, and even if you'd entered in short and got filled at the worst possible location with your stop above the high, you still could have made a decent profit. You then saw some maybe arguably better opportunities around the 50 moving average, particularly this candle here. Look, you got a rejection there, you got a rejecting candle there off the 150 moving average, and another rejection there, and then you see price sold down quite heavily down to the 200 moving average and beyond, testing these recent lows. So a little tip, and this little tip is, when you know a central bank is going to increase their interest rates, what you want to do is you can trade into the event. So this central bank policy meeting is going to be taking place on the 13th of September. So it's coming up this week. So what you can do is you can short the US dollar Turkish lira into the event. Now, this isn't trading advice. This is education to help you to see the kind of opportunities that you have. And then when the central bank increases interest rates, price would spike down, and then you take your profit on the spike. You see, because the market is now anticipating that the central bank will increase their interest rates. So once they've done that, the market then reinterprets it. Okay, if it's increased interest rates, what's next? If the central bank doesn't indicate anything next, then you might find you'll have a buy the rumor, sell the facts scenario when you have the exact opposite happening. But you would typically normally get the spike down. So that is one opportunity that's ahead. So places to look are to look at price moving around this grouping of the moving averages. Look at it as well on the 4-hour chart, particularly price around the 50 moving average. That does give you places to define and to limit your risk using those moving averages. They're respected levels. You can see how the 50 is respected there, 100 is respected there, 50 is respected here. You can see the testing of the 50 there, there, and there. All of these places offer excellent opportunities in order to limit and to define your risk. Right, so that is a potential opportunity that is ahead on the Turkish lira. Moving ahead to the next one, we obviously have the US-China trade war. Now, this has been a really big issue, and the issue has been increasing. It was widely expected last week that Donald Trump would announce $200 billion worth of tariffs that he was going to be putting on China, which he did. But he also had an extra surprise for the market. And that extra surprise was that he was prepared, as he spoke, he said there's 267, I think it was, extra $1 billion that's behind that 200. So that was a shock to the market, but the market's trying to interpret whether that's just bluster from Donald Trump. It's certainly not official policy, but it does show you how Trump is feeling. He really is in a full-on aggressive mindset against China. And over the weekend, he had a couple of tweets, which I've just put here for your convenience. He said, if the US sells a car into China, there's a tax of 25%. If China sells a car into the US, there's a tax of 2%. Does anybody think it's fair? The days of the US being ripped off by other nations is over. He's also then, when Apple came out and said that, their pricing is going to be affected by any tariffs that happens on Apple products. And Donald says, well, okay, why don't you make your products in the United States instead of China? Start building new plants now. Exciting. So Donald Trump is in a combative mood. And further, to add to that kind of context of the environment, there was the China trade balance to the US was released just for August. And you can see it's at an all-time high. So there is a massive surplus in the China trade balance to the US. And that surplus is only going to make things more difficult in terms of relationships between the US and China. And Donald Trump's obviously going to see that data, and it's going to incense him. And that trade. So one factor you must keep in the markets all the time is this US-China trade war. Now, if you have a look, I was short last week on the Australian dollar, Japanese yen for my fund. And I took profits this morning just as price hovered around here. I was trying to get some continuation into Monday. But this was the announcement when Trump, announced those further tariffs. And you can see that, price just sold off heavily. Now, the reason I'm wanting to trade a yen pair is because the Japanese yen is a safe haven currency. And what that means is when markets get spooked or worried, they tend to do three things. They tend to buy Japanese yen, buy the Swiss franc, and buy the US dollar. So also, because of the US-China trade war element, I favored pairing the yen with the Australian dollar, because if the trade war does accelerate between the US and China, Australia's economy will suffer because of the amount of exports from Australia to China. If China slows down, then Australia's exports are going to slow down. So that's going to be bearish for the Australian dollar. So that was an obvious currency to trade. And you want to be having a look at this chart in the coming week, because it does offer a good opportunity potentially to go short. You can see daily that there's a lot of pressure on the Australian dollar, Japanese yen. And the sort of areas you want to be looking at limiting and defining risk are here, these moving averages. Do you see how I've been looking at this chart for some time, and I can't remember, because this isn't my funds terminal. I can't remember where I shorted from, but I think I shorted from around this area, and I just put my stop above the 100 moving average. So once you've got a strong fundamental picture, again, this is not trading advice. It's just simply showing you the kind of things you can do. When I was confident that the Australian Japanese yen was in a bearish fundamental position, all I wanted to do was find a sensible place to put my stops. And a sensible place was behind the moving averages. And you can see, look, the 100, 200 moving average respected here, the 100 moving average respected here, and here, and here. So these were all opportunities that, if you're tuned in to what's happening, you could have taken those. Okay, let's go back to our keynote. Now we have NAFTA, the North American Free Trade Agreement. This is another ongoing saga. Again, there's more opportunities for you here if you're really tuned in. Donald Trump has been very combative about not doing a deal with Canada. That 2 Fridays ago, he said there's no deal. Trade talks with Canada conclude for the week, no agreement. And then over the weekend, he had a few sort of combative tweets again. Now, last Friday, it was expected that, should be able to do the NAFTA deal on Friday. No, still no deal. And Trump did say, look, Canada has taken advantage of US for too long. And that came out on the announcement when he said there's still no deal. Now, the likelihood of there being no deal is really quite slim. The fact that the US has done a deal with Mexico, and just the fact that the US was wanting to build a wall separating the US and Mexico, but they managed to do a deal with them. Canada are obviously much easier partners than Mexico for sure. So it would be, I personally would be very surprised if the US didn't make a deal with Canada. However, how that happens and how that's strung out is tricky, and there's going to be headlines to be interpreting and to potentially that are tradable. So it's just worth looking at the US dollar Canadian dollar chart. Okay, now here's the US dollar Canadian dollar chart. I'll just go to the daily chart here and we'll have a little look. Okay, so we can see that there's been a trend line break here. Okay, on the US dollar Canadian chart. Price has broken out of that trend line, pulled back, retested it, and is looking to head higher from a technical perspective. Now, obviously, for those of you who've been following my webinars for a while, I look at the technicals to define and limit risk. I don't use the technical to define when I'm not going to enter a trade. We have to put two bits of the picture together. We have to have the fundamental picture and the technical picture together. So looking at this, what we're looking at is we're looking to see if that NAFTA deal gets done. Because if that NAFTA deal gets done, I think there's quite a few percent, 2, maybe 3% priced risk in the NAFTA deal doesn't get done. Because if the NAFTA deal does get done, then I think the CAD will appreciate quite heavily, and you will see a US dollar, Canadian dollar sell-off, because the CAD, obviously, what's bullish for CAD is bearish US dollar, Canadian dollar. So just looking at that chart, you want to be aware of that dynamic that's going on, okay? And then again, the sort of places you'd always look to define and limit your risk against certain places. So if all of a sudden you got the NAFTA deal comes off and US dollar, Canadian dollar plummets, say that happened now, right now as we were speaking. Again, this isn't advice, but it's just showing you the kind of way you want to be thinking. Price would drop down very quickly, and then what you could do potentially is you could trade a retest of the 200, the 100, the 50 moving average with your stops above the high. Okay, because these are good places to define and limit your risk. And if price was just, if you were just here and you heard on the squawk, okay, NAFTA deal gets done, you could just enter very quickly on a short and pop your stop above the high, and then your first obvious target would be here, the 200 moving average. And then if price hit there and went through there, you'd look at your next targets, which would be this trend line that's from above. But to be honest, you'd know that that kind of thing happened, price would fall, and then even if you missed that move, you could then look at the pullback. Again, none of this is advice. It's trying to help you to understand how you would trade this kind of information and how you would deal with it when it comes out, because at some point this deal is going to get done. So I wanted to give you some guys direction, helping you to be educated, understand how you could make some informed decisions for yourself going forward. Brexit. It's an ongoing saga again, how Britain exits from the European Union. We had last week, Michel Barnier had said there was going to be a better Brexit deal. Sorry, that was the week before, but it turned out to be, he reversed that position after the weekend last week. And now starting this week, we've had an article out by the Financial Times. And what they were saying was that Michel Barnier has been instructed to do a constructive deal with Britain regarding Brexit. So the idea is that there's going to be some conciliatory moves from the European Union towards Britain. So that is kind of the sentiment that's entered the market. But then the opposite sentiment was Stephen Davis, a junior minister, has said that, there's a number of conservative rebels who are prepared to reject Theresa May's Chequers Brexit plan. So there was a bit of, two different contradictory sentiments coming in. Although I'd have to say, how credible is Stephen Davis? He's a junior minister. So the Financial Times is a very respected news source. So when the Financial Times are saying something, obviously holds more weight than if you just read it on a blog or something like that that someone said. So Financial Times, a lot of clout, and you need to balance these two issues. So just looking at the pound, US dollar, this is really worth looking at the pound. Like, the pound has got this heavy sell that it's been in. You can see for a number of weeks it's just been a strong sell. And when we go to, we'll have a look at it later, how strong that sell is. So If a Brexit deal gets done, what it means is that that Brexit risk, it will be priced out of the pound. So the pound would appreciate very, very quickly. And this is the reason why we saw the spikes in price. Like, this was a spike when Michel Barnier was saying we're going to do a deal like no other with Britain. Okay, that was the spike on the 29th of August. Okay, then over the weekend, he kind of backtracked and yada yada yada, and price sold off. There then was another spike. Now, if I recall correctly, this spike was basically that Germany was going to be more constructive with the UK, and they're going to get rid of that Irish border problem. They found a way around it. Things were looking really rosy. Now, if I was just looking at how price is responding to the news, it's quite constructive on the pound. Obviously, you have a rejection of the 50 moving average here, so you can see that price is really at a crossroads. And if you drop down on the chart, you can see that price has tested the 50 and 100 moving average, tested and rejected. So we're just really at a crossroads here. Now, what you guys have to do is you have to be tuned in to the story. What is the Brexit story? And as the story emerges, then you can take opportunities to short or to long. So when this news came out here, I went long the pound. Now, I went long the pound against the Australian dollar for different reasons, but it's the same kind of trade. I'm going long the pound, okay? And I just put my stop below this level because that was the level at which I knew I was wrong, okay? That's the level I knew, hang on, if that kind of news comes out and price goes back down here, it means, I've got it wrong, either a dodgy news source or, I've just done my analysis wrong, which does happen, okay? So use the moving averages as a place to define and limit your risk, okay? That's just a little tip for you, and it'll help you to know, well, how do I get out of a trade when I get it wrong? Particularly when you're learning, you're gonna make mistakes. So define, limit your risk, don't over leverage. They're good principles. Again, not advice, trading advice, but good principles of education for yourself. Now let's move into the week ahead. But you can see how many geopolitical concerns there are. There really are. It's a tremendous amount that's going on. So you've got to be tuned into these stories. Okay, Monday, we had the manufacturing production and industrial production out of the UK. They weren't particularly market moving data. And the data that was sort of quite significant isn't on this calendar, which is the UK July GDP, which has risen to 0.3% versus 0.1% expected. So that's quite good for the UK on the surface, but when you sort of dug down in the detail of it, a lot of that was from the service sector, and it was things like Britain was doing England rather was doing quite well in the World Cup from Russia, and so that always boosts consumer spending. And they had the Queen's, there was an event with the Queen, and all that kind of feel-good factor had boosted the GDP. But okay, it's risen 0.3% versus 0.1%, so that's quite good for the pound. But again, at the moment, as you can easily see, it's the Brexit sentiment that is really guiding the near-term direction of the pound. So you have to really interpret that. And this is like a two-way street you've got with the pound, haven't you? Because if the UK Parliament squabbles happen over what the best Brexit policy approach should be, you're going to have the pound being sold. But equally, sort of Brussels are saying, we might be able to reach an agreement with the Brexit withdrawal. So you've got to balance these two different sectors. What's going on in Britain's Parliament, what's going on in Brussels. But fundamentally, the pound is going to be sensitive to both negative and positive Brexit headlines. Okay? So if the deal was suddenly done, now that's interesting. It always seems to be when it always seems to be when I'm on with you guys, you get some kind of reaction. There's a strong reaction there in the pound, and I'm not exactly sure what headline that is. I'll go and look at it later, but that's going to be some headline. It's going to be something positive for the pound, and it's like I planned it. But you can see there, look, technically that's looking quite good for a short, but there's obviously been some headlined, some data thing that's just come out, and that's going to be probably a good news for the pound. So if something really good does come back for the pound, you can see the first target would be here, 1.3100, and then here I can't quite see because of my the webinar software that I use. Oh, that's it. I'm just going to move it to the side. Yeah, 1.32, 300 is another good target that you could reach there. Once the Brexit risk gets priced out of the pound would appreciate. So just have that on your radar. It's funny. I think that's the third time that I've been on the webinar and some significant news come out. So it must be very special for you guys, giving you a really good lesson, really good heads up what's going on. Let's go back to the yeah. Okay. So on Tuesday, there's nothing particularly on Tuesday. Again, you got the average earnings coming out of the UK, but that, as I've already mentioned, that okay, any positive data that's going to be in for the pound is going to only add to any positive pound repricing if there is some kind of Brexit resolution. But otherwise, you've got to interpret all of these UK data points in light of Brexit and keep them within that clear parameter. Then we're going on to Wednesday. There isn't anything particularly of interest on Wednesday, really. Thursday becomes a very interesting day. There's a lot going on. Got the Australian data coming out of the participation rate and then the unemployment rate. Now, the Aussie dollar is really sliding at the moment, and the reason it's sliding is because of those US and China trade tensions. So, the Australian dollar is being sold. Also, the Australian dollar is weak for a number of different reasons within the economy. There's kind of heavy household debt. The chances of a rate hike are already in sort of 2019. That's the time. But actually, some analysts that I've been reading are thinking, well, maybe a rate cut may be more in line with where the Australian economy is at. So have a look at these employment change data. They expect to be 26.7 thousand extra jobs added. Just have a little look at that. You might get a short-term sentiment trade out of that, but obviously the kind of scenario that I'd be looking at here is you're looking to sell the rallies. So this is a sort of scenario, again, not trade advice, but education, is that when the price appreciates, if there was really good employment change, like a real big boost in numbers, then that would typically be opportunities to sell the Australian dollar at a better price. So that's my bias on the Australian dollar. You can do your own research, just Google it and see the Reserve Bank of Australia, read a few analysts, and you'll see that the outlook for Australia is very dovish. Now, going forward into the day, the next the interest rate meeting out of the Bank of England is almost certainly going to be a non-event. That's what I'm looking for. There won't be any mention of much of UK politics or Brexit. The markets are just going to be, there's going to be limited pound downside risk from softer UK data or a neutral Bank of England statement. Just keep that in mind, that nothing's really expected from this. Brexit is the big focus and the big headline. Looking then onto the ECB interest rate. Again, okay, ECB, they're in a situation where they kind of have revealed their hand to the market. They've said that they're going to slowly taper off their QE program. They're going to taper it from 30 billion to 15 billion a month, and then at the end of the year they're going to be done with the QE program. They said they're not expecting to raise interest rates until the end of next summer. So that's really where the ECB are at. They've been quite clear. So what you want to look for is any deviation from that. Do they say, well, we might be raising interest rates sooner or later? The general data out of the Eurozone has been fairly solid. Nothing to get really too carried away with. But look at the emphasis that the central bank make. That's how you guys learn. You read the rate statements, see what the central bank is focusing on, and then when you see what the central bank is focusing on, that's how you know which data points to look for, which ones are significant, which ones aren't. And a good example of that is one that comes out later that evening, well, 22:30 GMT time. Now, this normally wouldn't move the market very much, this data, but the New Zealand PMI data is significant because Governor Orr explicitly said that one of the reasons for his shift, and he made a shift a few weeks ago, when he said that New Zealand is going to be on a lower for longer rate path. In other words, they were going to be less likely to raise interest rates. And one of the reasons he cited, was there was a slowdown in business confidence. So when you look at the chart here, you can see, look, there's been this slowdown in business confidence. So in May, it was 58.9. Then in June, it was 54.5. Then in July, it's 52.8. August, it was 51.2. So basically, it's heading towards that 50 sort of midway point. Anything below 50, and it's really starting to become, well, businesses in New Zealand are lacking confidence. They're lacking confidence about production, about the future, about how well they think their businesses are going to go. So the fact that Governor Orr is focused on this means you should focus on it, because guess what? If that comes in really low, 46, 45, what do you think is going to happen to the New Zealand dollar? The New Zealand dollar is going to sell. Okay, so you need to start putting this into context, understanding which reserve banks are focusing on which factors. And the way you do that is by keeping up to date with the markets, reading all the latest analysis, and staying in touch. That is the main issue for the week. There is also some CPI data out on the Thursday. We've got some US inflation, which is important. That's going to be important again. If you look at the US CPI, you see that the last data point in August was 2.4, which was the highest for absolutely ages. It was the highest since pre-2000. Yeah, it's highest since 2000, September the 16th, 2008. So that is a really good inflation data out for the US. They're obviously on a path of rate hikes. The Federal Reserve expected to hike again in September, and then one again in December, and it's looking maybe there'll be another 2 next year. So again, look at the CPI data. How aggressive is and that's what the market's thinking. How aggressive should the rate hikes be? Should it be faster? Should it be slower? And 2.4% is expected, so another really stellar reading. So have a look at what that reading actually comes out on, and that's going to again provide some guidance for what should be happening with interest rates out of the Federal Reserve. So that is the key data for this week. There isn't a whole lot. Okay, obviously got Governor Carney's speech, worth listening to, and got retail sales. Now they're worth looking at as well, because they will feed into the GDP data that will come out of the US. So again, look at the retail sales to see how they're doing. That does flow in to GDP. But apart from that, that is the week. Again, do look out for headline risk. I've outlined a number of them. And if you've got any questions, guys, please do ask your questions now. And I will be back again next week, same time, same place, 17th of September. And if there's anything you're unsure of or any questions you've got, just you can ask them now. Oh, here we go. Yeah. Yes, Ham, I am using the exponential moving average. I go into it on my webinar that I've done for HYCM, the difference between the exponential and the simple moving average. Very quickly, the exponential is more reactive than the simple moving average. They're calculated a slightly different way. What the EMA does, it gives more emphasis on recent prices. So I like to use the EMA. What is the fourth moving average period? Yeah, I've got a number of different technical systems on my chart. It's that fourth moving average is related to the RSI, which is in the window at the bottom. Um, that's that's not really necessarily helpful for you, Ham. I think I've got a 10 and the 5 EMA on as well, but it's the three big ones are the ones that are most helpful for you. Okay, please send me. Okay, Ham. Let me see. Last time we talked about your support. Yes, Ham. The support and resistance cost. It's here on the HYCM website, so you can actually underneath the education support website, you'll see it. So let me show you that. So Ham, just having a look. This is a really good. This is a good one for you to look at because what it does, it really helps you see how to define and limit your risk. Okay, so that is the one. Ham, can you see that there? It's this one here. Okay, that's the one you want to look at. And if you look at that, you will get a really good introduction concept. How to set take profit and stop loss. Okay, Ham, have a little look at that website. That will give you some ideas. I think, yeah, yeah, I think I'm using the 14 period, Mo. That's right. Oh, good, Ham. That's great. Good, excellent. But guys, well, hope you find that useful and helpful. I will again be back next week. Have a look at the things I've mentioned this week. See how they played out. Okay. Look at the moving averages, the 100, 200, 50 moving averages. Think, where could I define and limit my risk? How could I have done that? You know, if you're not a confident trader and you're learning to trade, use a demo account. That's what they're there for, to help you learn before you end up spending any of your real money. And you don't want to be trading properly yet until you've got a good understanding and a good track record trading on a demo. And that's how you want to do it. Don't use leverage, so only use the amount of only use your position size to match your account size. Okay, so don't use heavy leverage. It's a sure way to lose your account, especially when you're learning. Okay, guys, that's the end of this week, and I look forward to seeing you guys next week. Yeah, I use the 14 period in all times frames, Mo, but the technical aspect is down to you, Mo. The key thing that I really want you to understand is how to trade the market fundamentally, because once you understand, Mo, how the market works fundamentally, you can then apply any technical strategy to it at all. It doesn't matter. The reason I like the moving averages, especially for you guys, is it really helps you to define and limit your risk. It's quite simple, it's quite straightforward, it's quite intuitive. Okay, guys, thanks for your time, and I look forward to seeing you next week. Bye for now.